Good afternoon, everybody. This is the last panel, so bear with us. It's the Analyst panel. These guys provide all the information to all the investors, and they play a very important part in stocks. It's my opportunity as a CEO today to ask them questions. Usually they ask me questions. I'd like to know, starting, what exactly do you guys do? Donald, what exactly do you do? Describe to us a typical day in your office and what you do.
Sure. So I'd say first, Donald McLee from Berenberg Capital Markets. On a typical day, I wake up, kind of check news, see if any new data came out or companies made any released any press releases. Depending on what that data was, that might lead the morning for the day, writing about that and talking to clients about that. Outside of that, I think it's more just kind of a little bit of maintenance work, updating models, looking at where market rates are, checking industry news, and then also kind of getting on the phones, talking with investors and corporates and trying to get either flesh out some ideas you might have for a new research piece, or sometimes those conversations lead to new ideas.
So how much of your time do you spend talking to people, to industry partners, and how much of your time is really writing reports, reading reports, listening to the news?
It's hard to say. It depends if it's during kind of earnings seasons or not. I think on a typical day outside of earnings season, it's a lot more being on the phone and talking to people in the industry. But I think when companies are announcing, it's a lot more in the weeds and kind of just focusing on the models and getting research out.
So what's the fun part of your business, of your job?
So I'd say the fun part for me specifically is we run a pretty lean shop. So I have all the responsibility, but then also get all the praise.
Okay. So the bad thing about your job is what? Reading too much?
Having to do all of it can be bad, but then it can be rewarding down the line.
Okay. Anybody from the panel wants to add a point on this?
I think time management skills are one of the major traits for a shipping analyst, and one of the fun parts is that your time management plan always is destroyed basically the minute you come into the office. That can be annoying as well, so both fun and annoying, but as long as you have good time management skills, you always manage to get back on your plan, and then you can continue working as you were. But for me at least, I come into the office, I usually go home to my family to eat dinner, and then I have the second round of the day, the second leg, which is at night, and then that's when I'm usually the most productive, because then it's fewer distractions.
So overall, is it a satisfying job? Is it something you like doing, you love doing, you feel that you influence the markets? It's something that you really like, or is it a stepping stone towards something else?
It's something I love. I wouldn't do it if I didn't love it. So this is something that gets me up in the morning, definitely.
Yeah. Very fun job, very dynamic, a lot of autonomy. Nobody's saying, oh, you have to give this rating or give this price target. Enjoying the relationships with people, clients, and management teams, sales team over at Jefferies. So in that regard, it's definitely a fun and rewarding job.
Do you talk mostly to institutional investors, ship owners like us that pressure you to come up with a nice report on us? Where does the pressure come from? Your bosses that want to see results and people trading? Where does the pressure come from?
Yeah, I mean, when you downgrade a stock, always the ship owners, they get really upset, especially international ship owners, Greeks.
Look at the audience, not me.
But
you don't cover us, so.
No, I think this is a great job. It's a great job because somebody's paying you to give your opinion, and if it's right, it's fantastic. If it's wrong, you lose no money. So it's 50-50 usually this. If you are 51% right and you manage to identify some opportunity, something that other people have not seen, or something that some people might have not seen, but they might have not put a lot of attention to, you feel great. You feel that you have discovered America.
Yes, this is something I find very intriguing, that you try to give a report of not what has happened, but what will happen in the future. And we all know how shipping is a very cyclical business, and it's extremely difficult to predict the future. I mean, I'm involved in 2 sectors, and I can't do that. But you are supposed to be able to do it in, 6 or 7 or 8 different things.
But this is not the most important thing of our job. I don't think that investors, they care so much about us predicting the future. I mean, it's nice when you are successful, but they can do a better job. Otherwise, the roles would be reversed. We would be investing the money, and they would be doing our jobs. But what we have to do is to try to see what are the drivers for its stock, what are the drivers for its industry, to identify 1, 2, 3 important points that will make the stock to move in one way or another. Whether one of these points will work out, I think the decision is on the investor. But people ask you, if oil prices go up or if OPEC cuts production, which sector is going to be affected? Is it going to be the crude tankers, the product tankers? And then they can make the decision, and they will want to know which stock is more levered to one driver, which stock is more levered to another.
Ben, how do you compare yourselves amongst yourselves? I mean, you all are in the same business. Do you read the reports of everybody else and then write your own, trying to find a compromise? Do you try to be totally analytic and look at each company without taking into account what everybody else does?
I only read Fotis' reports.
I don't get yours.
No, I try not to. And I do, from time to time, somebody will send me a report saying, hey, did you see this? Usually I don't even look at it for that reason. I want to try to be as unbiased as I can be. And I will say, because it's no fun if everybody agrees, I will say I differ a little bit with Fotis in just having themes. Like I take it very, like if I have a buy rating on something in the stock tanks, which happens a lot, I take it very seriously. Like I still have a job and I'm still employed, but there are people, and in my firm, there's a lot of retail investors who look at a report that I write and think that it is, it's some sort of holy, scripture, right? That this is the way that things will definitely be, and I don't want people to lose money on my opinions, right? So,
Joakim, you wanted to add something?
Yeah, I kind of agree with Ben. So, and also, Fotis, was it with the 51%? Because in theory, if you're 51% right, you add value. But we obviously aim to add more value than that. So when you have kind of the Valley incident, the tragic dam collapse, I think, at least, I can't speak for everyone, but I think most of us didn't foresee that event. So when it happens, obviously our target prices, our recommendations are wrong, our estimates are wrong. So then we add value to our clients by issuing reports, continuously updating them on recent events. And I think that's one of our biggest jobs. And for myself, I think I issued 20 reports on the Valley incident alone in the past 2 months.
Who reads your reports, Randy? Who reads the reports? Is it the institutional investors or is it the retail investors?
It's usually the shipping companies that they read the reports.
Or is it just us that read your reports? Because, yeah.
Yeah, no, it's all of the above. We have this kind of blue matrix software, and it kind of tells us who's reading the reports, how often they're reading them, when they're reading them, all these things. So we have a lot of analytical data around that. And right, it is shipping management teams for sure. It's a lot of institutional investors, some long onlys, a lot of hedge funds, definitely some retail, family offices, individual investors, all of the above. So it's definitely a diverse audience in that regard. And then, as kind of Ben was saying, our job, at least at Jefferies, 40% of my kind of analyst scorecard and compensation, all these things, are based on, you know, my picks. 20% on stock performance, 20% on earnings estimate accuracy. So there's a lot of pressure to be right, both internal and then external investors want you to give them good recommendations, right? And it's very objective, because you can see if you have a buy on this, how did the stock perform? You said the EPS was going to be 22 cents last quarter. What was it? You know, so it's very black and white, very objective public job. So,
right. So you do, all of you, I think, most of the analysts that I've seen, they have more buy recommendations than sell recommendations. Despite that fact, you know, we have an industry where all the stocks are trading significantly below their NAV and below where you guys say that they should be. So I cannot blame you for the industry not being better and stronger as all us think it should be, owning the companies and comparing prices to NAV. What is the reason for this lag that we see? It's not you publish generally a little bit more bullish reports than where the prices are. What are the reasons? Is it the cyclicality? Is it the small size of the companies? We had this discussion in the previous panel as well, but it's interesting to listen to the analyst's view on that. Donald?
Sure. I think cyclicality and company size are both factors, but I also think maybe trying to get the message of people to understand the shipping sector to a broader audience is also something that's hard when they look at kind of how the stocks have traded and trying to understand some of the complexities of the industry. I think sometimes they have a hard time wrapping their head around it. And then when you look at things like the company size, some people say, you know, this is an interesting idea, but it might not make the most sense for my firm. On the cyclicality side, I think that in a bull market or in a healthier market, I think it's kind of easier to get people to look at the sectors. But I think when things are challenging or emerging from a challenging time, that's when it's most complicated.
Joakim?
I think it's different reasons between the different segments at the moment. For instance, in Drive, it's I think an expectation priced into the current pricing of the shares of potentially a further downside to the asset prices and also deteriorating vessel economics. So I think that explains a lot. That said, I think some of the shares like Genco trading implicitly 15% below all-time lows on a vessel value is too much. That's why I have a buy recommendation. I think Golden Ocean, which is trading at a 30% discount to its NAV versus a premium historically, it's too low. So that's why we consistently have buy ratings, because the market has sold off too much. When it comes to oil tankers, I think it's a different story. You have rising asset prices and the sentiment has shifted. Still we see shares trading below NAV. And I think one of the reasons is the ghost of trade war. Although oil tankers is not the segment that's going to be hardest hit by the oil war or trade war, not at all, but it is still hanging over the whole shipping segment. So I think if you get a situation where that trade war goes away, I think it's going to help the whole NAV pricing in every segment.
Foti, do you agree with that? I mean, for me, as a ship owner, I see that the people that really know the business, do the business, they buy and sell ships at NAV, but in the stock markets, we do it at 50% of NAV today, roughly. Is that the reason, the trade wars? What's the reason? The size?
I think market is not that naive as a lot of the ship owners think. And market usually tries to see forward, tries to see what's going to happen the next 6 months, the next 12 months. Obviously, the market, especially for dry bulk, tells us right now that NAVs are not real. And I think that a lot of ship owners also agree. That's why we do not have transactions right now. We see NAVs from Clarksons, from vessel values, but we do not see ship owners act on these prices. So perhaps something is wrong with these prices. They are backward looking and the shareholders are trying to see forward. But there is an additional reason. The problem is that right now the industry does not have an audience. And the audience of this industry used to be hedge funds that they were focused primarily on energy. The energy market does not have specialized investors. And of course, the big companies in the energy market, they still have a following, but not from specialized energy hedge funds as they used to be 4 or 5 years ago, before 2015 actually, when oil collapsed. Right now, you have a lot of generalists. So the investors that they look at energy, they also look at technology, they look at healthcare. It's a much harder sell to try to convince a generalist investor to buy a dry bulk shipping company with no earnings, or a tanker company that has been comparatively much better, when you have a volatility of charter rates of 120%, annualized volatility in the charter rate, and annualized asset value volatility of 35%. This is an extremely volatile business, and for us trying to claim that we can predict the future, I think we should be a little bit more cautious on promises that we make.
No, I think, and I can express my views as I'm moderating, so that's why I'm doing it, really. But I think that the size of the industry is small, as Hamish said in the previous panel. You know, the total value of all dry bulk is around 70 billion, I think he said, or something like that. It's still not a huge number, and the biggest company is just 1%. So obviously the companies are small, and the small companies cannot appeal to the big institutional investors. The audience for this size of companies should be much smaller investors, family offices, retail investors, things like that, perhaps. I think that's something that we should try to attract more. How much is the retail participation in the shipping business? Does anybody of you know?
So, if you allow me, there is this audience, but it's not common equity investors necessarily. You see that there is a lot of institutional money that they try to get into other parts of the capital structure, on the financing side, on the mezzanine side, private equity investors. There is that. It's something that 15 years ago did not exist at all. It's just that when you buy the first loss, liquidity is much more important right now than it used to be 3-4 years ago. If you do not have the ability to exit, that's why the little investors' interest has been concentrated in 1 or 2 companies in each sector except of dry bulk.
Ben, do you want to add something on all that? I mean, I'll mention also governance, which has also been considered an issue sometimes, that maybe that's one of the reasons why we are underperforming.
Yeah, I think governance is an issue. We can address that maybe a little bit more broadly in a minute. I think another challenge is that, again, for many broader investors, or maybe they're even to some extent specialists, they have been hearing from guys like us or from the management teams for years, espousing how great the opportunity has been. And NAV, whether or not you're trading at a premium to NAVs, the shares have not performed well. And in this great, bull market has not delivered. And I certainly think there is investor fatigue. And furthermore, I think that the industry as a whole, for governance reasons or otherwise, has something of a bad reputation for not being capital disciplined. And there is a fear, I know, because I hear from investors all the time, there's a fear that, when the market starts to get very good or stocks start to trade close to NAV, ship owners are going to lose all capital discipline. They're going to go out and order ships, and before you even really get a chance to participate in a legitimate bull market, the whole thing's going to roll over. So what's your real upside? You're in a bad market now, and if your best case scenario is just sort of ho-hum, well, they can do ho-hum anywhere, right? They don't need to be in shipping.
Joakim, you wanted to add something?
Yeah, I think Ben is really on to the issue here, because last dry bulk cycle, at least in 2013-14, you had a lot of generalist money coming in, and they ordered a lot of new buildings, and that basically cut the cycle short. So now trying to raise kind of capital and getting investors excited about dry bulk was hard last year. This year, after the fourth quarter disappointed against all predictions, after the Val incident happened, so the risk premium investors now are tying to this segment is so much higher than it was just 1 year ago, or maybe 7 years ago. So to get that capital and to get investors to invest in so illiquid shares with low free float and so on, I think it's become a much grander challenge than it has been in many years.
Sure. And then to add to that, you tell the story of these attractive outlooks for certain stocks, the investors all about it, then they pull up the chart on Bloomberg or FactSet or whatever, and they say, oh, I can't show this to my PM when the chart's down and to the right? So they just, hey, we'll miss the first 15, 20% upside, and then we'll get in, kind of. So there's a lot of interest, maybe on the sidelines, in that I'm not going to jump into this falling knife. Let's see it start to rebound a few quarters in a row, and then we'll get in.
Yes, of course, in dry bulk, we saw in 2016, we saw shares collapse, a lot of companies in the brink of going Chapter 11 and bankruptcy. But at the end of the day, at the end of that year, if you looked at the stock performance, it was spectacular, but not many people invested in it, but it was spectacular. Shipping is like that. I mean, you know it very well. We have many, many years when the returns are suboptimal, and then suddenly we see a couple of good years. I think that my own view is that the capital markets, in order to show appreciation for shipping, they need to see earnings come back, and they need to see them come back and stay for 1 or 2 quarters or something like that. And I think that's, Fotis, the difference why we see that the NAVs are higher than the actual stock values, because the NAVs are people that are there for the longer term. So they see that there is a value in an asset looking 10, 15 years down the line. The usual investors in shipping, they only have a 6 months or a year horizon. And if they can't see the profit, then they will not invest. And I think this is one of the main reasons why we have this discrepancy. But anyway, it's not about...
Just to add, though, that if the market does not come back soon, in a year or whatever it is, this NAV is being eaten by the negative earnings.
Oh, of course, but...
The market puts a NAV discount, both because asset price might drop, but also because of the negative earnings that they are eating the cash position.
Believe me, the ship owner also calculates that he will lose money for a year, but still he thinks the NAV is higher. But anyway, let's not spend too much time on this. We have just 13 minutes left, and I want to ask your opinion about the future. I don't want you to tell us about individual stocks. I just want to tell us about individual sectors, because I believe this is really, all companies have all dry bulk companies trade very similarly. Some are better, some are worse. But the major thing that concerns us is how the market will do. We are all market takers in this business. So starting from you, Donald, can you rate dry bulk, wet, containers, LNG, and offshore? Which one you think will do the better till the end of this year?
I'd say
and how much better?
That's the tough part to answer. But,
okay, but just rank them in your preference.
I'd say in terms of my preference, LNG is probably the easiest one to see as a sector that outperforms, just based on the amount of liquefaction capacity that's coming online and kind of the intermediate term supply gap where there won't be a lot of vessels, well, there's a lot of vessels delivering this year, but in 2020 and 2021, I think there's limited supply growth.
Okay, LNG is one.
Yeah, I'd say maybe in terms of sectors that I think are going to have the toughest or the most challenging time for the next 12 months is probably offshore, and just because it's so tied to commodity pricing.
Okay, and between dry, wet, and containers, how would you rank them?
Depending on the timing of any potential resolution around the U.S.-China trade tariff situation, I think containers is poised to outperform. After that, I'd say I'd probably have the tanker sector next, and that's just with the potential for some supply disruption on the IMO 2020 side, and maybe some relief as vessels slow down, and then that'd be next would be dry bulk.
Okay, thank you very much. Let's move to Joakim.
Yes, I just wanted to note that containers and offshore is covered by my colleagues, so I don't have a view on that here today. But I think I'll start at the bottom. So dry bulk is ranking the lowest, but we still have a 56% upside over the next year on our dry bulk.
56% upside.
Yes, correct,
Okay.
on our dry bulk share index.
That's the point I was making. The analysts are optimistic. Let's hope that they are right.
But the reason it's ranking the lowest is because the risk is extremely high in dry bulk. So when you adjust for the risk, you get the lowest Sharpe ratio in our range.
Okay.
But still, we are also very positive towards LNG carriers and VLGCs. I think the LNG carriers, they're closing in on the second year in a row with close to double-digit supply growth. So that would be a concern in many markets. But what we see on the demand side is new liquefaction projects coming online. We see actually some of these projects are front-running the delivery of vessels, which is a rare situation in LNG carriers. Last year we had all-time high spot rates for a very brief moment. So we think it's going to continue to rise. And for VLGCs, we think the US exports are going to really support that sector in 2019. And we do see several consecutive years of improvements for VLGCs. So we actually have 103% upside in VLGCs and 97% upside for our covered LNG carriers. So
wow.
These are big numbers, but you got to remember that this is cyclical, and when these shares start to move with the cycle, they move fast. So this is based on our mathematical econometric models. Topic, oil tankers.
Oil tankers.
Yeah, we have a massive 145% upside. Did
you listen to that, audience? 145% upside in a year.
It's what we have, and if anyone needs to see the calculations, please reach out. I'll go through it with you. So the reason is very low supply growth. We have extremely good demand growth, even with the OPEC plus quotas in place. We have the IMO 22 kicker coming in with the vengeance from 2020. I think we will see oil product tankers really performing well next year. So we are very optimistic towards oil tankers for the
Eddie,
next
can you
year.
listen?
So with a Sharpe ratio of almost 4 on oil tankers, that's it's been a long time since I've seen those kind of numbers.
Thank you. Randy, do you share that optimism that both these guys said that the markets will be better at the end of the year than what they are? And
it's hard not to, being at the dearth levels we are now, and my blood type is B positive, so might as well be a little optimistic. Yeah, I kind of share their sentiments. First would probably be wet tankers, both crude and refined products. I think everybody wins there with IMO 2020. You're already seeing kind of a further dislocation of an already diverse crude and product trade, new routes developing pretty much weekly that we haven't seen in a decade plus. The certainty of demand on tankers is very high. The conviction there and the timing of the improvement. I think after you get through refinery maintenance season, maybe that starts kicking up in May, June, maybe July. Second would be LNG. Same thing. You know, you have come off dramatically from 180,000 a day, let's call it, in December to 35,000 a day now. You don't get to 35 if you didn't get to 180, so a lot of that was kind of pulled forward demand. We think with all the liquefaction facilities coming online this year, slowdown in new build deliveries later this year, so we think by the end of this year, you get rates back to 80, maybe 100,000 a day. Again, a lot of seasonal effects there. And then third, I'd say dry bulk. Valuations are definitely low. They're baking in Vale offline for multiple years. We think Vale is offline for a couple quarters. We are bearish, I guess, in terms of short-term rates and fundamentals in that regard, but the equities are bearish for forever, it seems. So that's kind of our top 3 picks.
So containers and offshore are the 2 worst ones?
Yeah, I guess containers, I just feel like the risk reward is both minimal, maybe the reward's minimal and the risk in terms of when you think US-China trade war, rightly or wrongly, you think, well, who facilitates that trade? And it's container ships, right? So especially coming from the Far East. You could argue that they are above dry bulk in the next 6 months, so that's fine. So either dry bulk container, let's call it tie for third, and then offshore at the end. We don't cover any offshore companies, so
Foti?
by default.
I think that for the next couple of years, there are a couple of themes that they surround the shipping industry, that they drive the shipping industry. The first one is obviously the IMO 2020 and the implications that it's going to have for all sectors, primarily the crude tanker market. The second theme is the growing, the expansion of the US as an exporter of hydrocarbons. And this is not only for oil, it's for products, it's for crude, it's for LNG, it's for LPG. My view for shipping, if we narrow it down, is that my best sector would be LPG. It's coming from 2-3 very weak years. What is changing right now is that the US is growing its NGL production. Permian production is growing very rapidly. That creates oversupply of natural gas liquids. Right now, we have certain constraints in exporting US propane, US ethane, and this is primarily infrastructure constraints. There is no fractionation capacity sufficient enough. We do not have sufficient export terminals, but this is going to change, and it's going to change within the next 12 months. When usually shipping is an arb business, when you have a very low cost of domestic production in one part of the world, and very high price in another part of the world. And this is happening even today where the shipping rates are not that strong. So I think this will create significant demand for VLGCs and all the gas carriers. The second sector along the same lines is the oil tankers, both crude and products, because US is producing more crude. It has cheap resources, and because of the IMO 2020, will create the incremental demand from the 1.3, 1.4 baseline demand to produce more distillates, so the refineries will have to run faster. I'm a little bit confused if I should rank on the third place container ships or a little bit uncertain container ships or LNG carriers. I think that LNG carriers, first of all, right now prices are for LNG are a complete disaster, and if you have low commodity prices, it's hard for the shipping business to make a lot of money. Shipping business is whatever is left between the price of the producer and the price of the consumer in the other part of the world, and this gap is very, very narrow. The other problem for LNG shipping that I'm not extremely excited is, first of all, except of the new orders that they were placed the last 12 months, 66 LNG carriers in 2018, record year of orders that they will hit the market for sure, is the fact that this market is not liquid and is controlled by the producers and the major players. And if you go to the Cheniers of the world, that they will need a lot of ships, to the Qataris, they will tell you, we are not going to charter existing vessels. We are going to give a 5-year charter to build more ships. So the order book is going to increase even further. So that makes it a little bit hard for the market, for the LNG shipping market to make great returns. I think that the container ship market next year has a good chance to be a good performer because the order book is very low. Next year, based on our estimates, based on Alpha Liner estimates, the supply growth will drop below 3%. Why the 3% is that important? Because usually this market grows alongside with global GDP. So if global GDP is more than 3%, and most of the analyst estimates is around 3.5%, we think that we're going to have an improvement. And also, this is a market that is controlled by a few liner operators. And these liner operators are not putting a lot of scrubbers. They will slow steam. So for 1 year or two, I think we're going to have an okay market.
And you didn't say something about the dry bulk. I presume the previous three companies, three sectors that you mentioned, you see share prices increasing. You see an improvement in values from where we are today, right?
I think that the liquidity discount for the liquid stocks will remain high. But I would expect, yes, they would increase. The larger companies, the more liquid companies, they will trade better. The smaller, more illiquid companies, they will maintain a liquidity discount. For dry bulk, I would expect, before I touch this market, a major event, a Hanjin event type of event, some big bankruptcy where prices will reset at more normalized levels to reflect the supply-demand outlook. I don't think that asset prices reflect that. When this big bankruptcy happens, obviously, a lot of people will panic. Let's not forget that the balances for most of the dry bulk companies right now, despite the terrible market, are still very strong. Last year, it was a good year. 2 years ago, everybody restructured their balances. They recapitalized the companies, the ones that they didn't go bankrupt. I think that we need another reset before we touch dry bulk.
The Vale incident was a reset, I think, but you expect an incident?
I mean, from the ship owners' side. Some, I don't know, people are talking about companies with VLOCs, that they have financial difficulties, but there are going to be a lot of companies.
For offshore, I presume, because I see we're short on time, for offshore, I presume you're not very positive, or what's the...
I do not spend a lot of time on
You don't spend time on it, okay. Ben, you are the last one.
I'll be quick. Yeah.
Good.
So I think honestly, what I've learned over the years is sometimes psychology is more important than fundamentals. And I think that if I had to pick one sector and I had to put money on this is probably going to be higher a year from now than it is right now, it probably is dry bulk. I can't tell you that I love dry bulk, and I can't even tell you why dry bulk will probably be higher next year, other than it is just so awful that at some point, things that are awful don't stay that way. You know, and I agree with some of the things about, you know, U.S. exports and all that kind of thing, but I think there is outside of maybe IMO 2020, there's a lack of real authentic belief in money behind it. And so I think I'm not as excited about the crude tanker market. I think it could be up, but I don't think that we close the NAV gap this year or next. I agree with Fotis about LNG. I think it's okay, but that's probably the last area I'd put money in right now, frankly. I do like the LPG, though. I think that's a little bit different. And offshore, I think offshore kind of does nothing. I think it just kind of hangs out because people don't have any conviction there, and they don't have any reason to have any conviction. And so that's the real thing, is people need to have a reason to buy some of these things. I think you could have reason to buy the dry bulk because it's awful. You could have reason to buy tankers because of IMO, but if that ends up, you know, not being a big deal, then...
And containers?
Containers, people don't care about containers, I'll be really honest.
That's what I realized, yes. We are a container company, one of our companies.
No offense, but
no problem.
I get one container call for every 100 other calls, so.
Right. Okay, guys, well, thank you for your views. They are different. They're not the same. Donald thinks LNG is going to be number one. Two guys think tankers are going to be number one. One guy thinks dry bulk is going to be one, and the Fotis, you think LPG. So it's quite a variety, but if I try and take an average here, I would say that everybody thinks that the tankers will do decently. On dry bulk, it's divided, something very bad, something very well. Offshore is unanimous, not too good. And containers and LNG, you know, so and so. But correct me if I'm wrong, every company is going to do better than where it is today or not? Every sector.
This wouldn't be shipping if tomorrow wasn't better than today, right? So
that's exactly how we think as well. Okay, guys. Well, is there any question? Yes?
Thank you. Thank you for taking my question. Thank you, Nicholas. So it started to occur to me a long time ago, and I actually had done some of the maritime indexes for Nicholas at a point, but that perhaps some companies, and whereas the horses are out of the barn, perhaps some companies really shouldn't have gone public, you know, and in a very volatile sector, perhaps the strongest. But I think the charm of the bankers tend to coax owners into going public, and so, you know, that now you have a new god. You have the market's god, and it can be very capricious. So with values, you know, with the prices so low, where's the owner's strategies or principal strategies perhaps to, you know, scheme up going private again and be, you know, and get control over your own lives and your companies and you know, perhaps you talked about that and covered that ground, but so what are your thoughts on that?
Who wants to answer that question?
I don't know about going private again, but there's definitely been a disconnect between earnings and equities, and we've seen that. So we cover 28 shipping equities at Jefferies. 21 of them have either repurchased shares or authorized a share repurchase program in the last 5 or 6 months. So just today, I think DHT announced some more share repurchases. So that's going to be a common theme, especially with free cash flow and equities trading so poorly. In terms of taking it all the way private, you'd have to have a third party coming in and kind of forcing that issue. I don't think any public CEO is going to say, hey, let's just take this private. Let's stop the equity markets. We don't want that public access to public capital. That's going to be difficult.
it has happened before, but I think really probably the person to answer this question is you.
I know. I think that it's worth being public even for a small company if you're not looking at capitalizing on the equity that somebody has immediately. I think it's worth being public. It gives a public company much better access to many more ways of finance and cheaper ways of finance. Life is becoming difficult for smaller private companies. Being public still is something that helps. And with that, I think I would like to end this panel. Thank my panelists here. Continue doing what you do. We need you. You are a very important part of this industry. Thank you very much, and thanks Capital Link for organizing it, and thank you all for staying.
Thank you to everybody, guys. Thank you for staying for the whole day. I think we had a great event. Thank you, Aristides, and thank you to the analysts. I think it was a super event. Thank you. And let me tell you, this year was not as easy because exactly the investor interest is not there, but I think we pulled together a tremendous event. So thank you to everybody.